For this unit on risk, we're going to talk about insurance, and there's just so many terms with insurance that I thought I would go over them with you. First of all, the term is deductible. Deductible is the amount of money that you will pay before the insurance will start to pay. Your health insurance will start paying on like doctor bills and stuff like that, but it won't start paying. You will have a certain amount of deductible to reach before it will pay on bigger things like a hospital stay or something like that. Now, your insurance is cheaper if you have a higher deductible, but that means that you have to keep, when you have a large medical bill, that means you have to pay more money up front. That's called out of pocket expense. So if you're rather healthy, maybe the higher deductible is okay. But it's a good idea to have that money put away somewhere so that you have it in case of an emergency. Premium. Premium is that amount that you pay every month for that insurance. And it can be some insurances you do monthly, quarterly, or semi-annually. Health insurance. Health insurance is required by the law to have health insurance. It pays for doctor visits, hospital visits, your medications. Different health insurances pay differently. Your copayment. When you go to the doctor and you go to a doctor's visit, they will ask you for a certain amount of money, maybe $20, $25, $30. If you go to a specialty doctor, it's usually more than that. That is called a copayment. Every time you visit the doctor, you copay, and the insurance takes care of the rest of it. Now, once you go up to your deductible and meet your deductible, you start with co-insurance, like on a hospital stay or something. But you have to meet your deductible. So if your deductible is $2,000, you have to pay the first $2,000. Now, as soon as that happens, the insurance then they will pay 80% of whatever the bill is, and you're responsible for 20%. Then there is usually in your policy another number that once it goes over that number, then they will start in and they will pay 100%. So if you have $100,000 medical bill, you don't have to pay all of that 20%. They will start and pay more. Now, there's basically two different kinds of health insurance. There's an HMO and a PPO. An HMO, it's usually a little bit higher to pay for, but you have more choices. They negotiate with doctors and hospitals for how they will pay them. And the doctors and hospitals that they have negotiated with are called in-network. And if you go to some of their in-network doctors and go to their hospitals, then they will cover it according to the agreement with the hospital and the insurance company. You can pick and choose who your doctors are, and you can go out of network here, and they will still pay. PPO usually costs a little bit less, but it has a certain number of doctors and a certain number of hospitals on their list, and they just don't pay for people outside of their network. The network is, again, the doctors, the hospitals, wherever that they have negotiated with, pharmacies, anybody in the medical field that they have negotiated with, that they will pay their insurance to. Self-pay. Some people, there are some insurance pays out there that they are on self-pay. And when you go into a hospital, you tell them that you're self-pay, and you have to give them a lump sum. So if these uninsured people, they can negotiate. Sometimes they will even go down like to 50% of the cost. So if you had a $100,000 hospital bill, if you pay it in one lump sum, then you would have to pay $50,000. Now, there's two different kinds. It's government-based. That's Medicare. Medicare is for people who are 65 years and older. It does come out of their Social Security check that they get. There's a certain amount that helps pay for the Medicare, and it helps with all kinds of different medical needs. You also have to have an extra insurance with this. Medicaid. Medicaid is for people who are low income or out of work. For children, if their parents are out of work, then they can be part of this for as long as their parents are out of work. Now, there are different kinds of insurance that you can get, like when you start working. This is called disability insurance. This disability insurance, it is you pay a amount every month, and if there's a reason, like you have an accident or something, and you can't work for a month, then they will pay an amount to you to help out with your living expenses. Now, notice that there's two different kinds. There's one that will just pay you for a limited amount of months, and like 20 months. And then there are some that will pay you until you can go back to work. That is called disability insurance. Now, then when you are looking at what happens when you're in an accident and you are physically disabled and you have to have some kind of care for the rest of your life, that's called long-term care insurance. And the sooner you get this, the cheaper it is. Long-term care insurance is if for people that are like they have to be taken care of all the time, like in a nursing home. And it's not just old people, because if you read in your dialogue that you're supposed to read, 40%, that's just a little bit under 50%, are people that are younger than 65, between the ages of 18. When I was first going to college, I found a job, and the only job I could find was working in a nursing home. And in that nursing home was a person that was in his 20s, and he had been in a very bad car accident and was paralyzed for the rest of his life. This is the kind of, so he is in long-term care for the rest of his life, and they didn't have long-term care insurance at that time. So this pays it pays a certain amount every month for however long that this person needs nursing care home. Then there are different kinds of life insurance. Life insurance is optional. This is the only kind of insurance that you will never be able to get any money back from. You pay it, so someone else gets the benefit. When you have a family, you should really have life insurance of some kind to help in case of your death, that your family will be taken care of and they will have some money to take care of things. There's three different kinds. There's term life insurance. Term life insurance is when, like, you get it for 20 years or 30 years. You pay that amount for those many years, like when your children are small, and so that they would have money to live on after you were gone. And it is the lowest cost. It's the cheapest. It does not build any kind of value. So it's kind of like rent money. It's money that you pay to them. Credit life insurance is a kind of term insurance. It is only for the term of your mortgage. So in other words, when you take out a mortgage, if you get a credit life insurance, that insurance would pay for the rest of your mortgage if something would happen to you, and it would be paid off. Now, there is no cash value to this at the end. Whole life insurance, the sooner you get it, the younger you get it, the cheaper it is. Usually it does not go up any. So if you get it for $20 a month, for the rest of your life, you give them $20 a month. It's life insurance. You pay the same amount every month or every year and until you die. And then at your death, they will pay the amount that you negotiated with. If it's a $25,000 policy or a $50,000 policy, a $100,000 policy, whatever the policy is. Universal life, you pay for your whole life again, but it does give you some different things that you can change. Like you might be able to change the amount you're paying. It might be different kinds of things like that. I don't see very many universal life insurances policies. So that is about the kind of insurance that we get for health and life and disability. And so I'll have another video for the car insurance and the house insurance.